Bismillahirrahmanirrahim. Assalamu alaikum, everyone. My name is Yasir Yameen, and I welcome you all in this financial reporting session. My friends, in today's session, we'll be doing one mock examination question, which is for 2024 March attempt. All right. So this question is from Consolidation. Consolidation is one area that is routinely tested in your examinations. So you should be well prepared for it, and let's see how this question goes. Guys, so here we have a question which requires us to prepare a consolidated statement of financial position at 30th June X7, and the whole question, just for the purpose, just for the sake of preparing a consolidated SOFP, it is for 20 marks. Yeah, it is for 20 marks. All right. So let's go and read this. Examiner says, Panama company operates in the manufacturing sector. On 1st March 20x7, now examiner is going to mention something which is related to 1st March x7. Guys, if I were you now, so in an examination question, whenever I see such sort of a date, I will, certainly jump and look at the accounting year end. In this question, my accounting year end is basically 30th June X7. I can see examiner has written the statement of financial position of the two companies at 30th June X7 were as follows. So my accounting year end is 30th June X7, whereas your examiner is going to mention something which is related to 1st March X7. So this means just 4 months before the accounting year end. March, April, May, June. Just 4 months before the accounting year end, we are going to discuss something. Examiner says, on 1st March 20x7, it means Panama acquired a 75% interest in a supplier Trilby company. So, basically, your examiner is telling you that the acquisition date is 1st March X7, which is 4 months before the year end. And Panama has acquired 75% interest in supplier. So I would be writing holding percentage here, which is 75%. I'm just making notes of the relevant data so that I do not jump onto the question sayings again and again. So it says on 1st March X7, it acquired a 75% interest in a supplier Trilby company in exchange for $200,000 cash and one of its own shares for every 4 shares acquired in Trilby company. So basically your examiner is saying that there are 2 forms of consideration in this question. One is cash consideration with a value of 200,000. And the other thing is shares consideration. And this is based upon one of its own shares for every 4 shares acquired in Trilby company. That is the shares policy, exchange policy is 1-for-4. Yeah. So for every 4 shares that we acquired, we've provided one of our own share. So if I were to calculate the valuation of this shares consideration, you see, we provided 1 share in exchange of 4 shares we acquired. So first of all, the question comes up to be, how many shares did we acquire? So we acquired a 75% interest. If you see below, SOFP of both individual companies is provided. And if you come down, you can see that share capital of both parties have been given. I guess this is in thousands, yes. 100,000 and 80,000. So 80,000 is the share capital of your S company. But what's the par value? If you closely, if you quickly just move on to the question and search out for the par value, it's written at the end of note number 1 that both company shares had a nominal value of 1. So par value is $1. Now this is important information for you to note, otherwise you would have done the entire question wrong. So 80,000 is the share capital of S company when a par value is of 1. So that means number of shares of S company is basically 80,000. And if someone was to ask me how much have we acquired, number of shares acquired, that would have been, for every, we acquired 75% interest. So technically 80,000 are the total number of shares and we acquired 75% of it, which is 60,000, right? And now if someone was to ask me that how many shares were given as consideration. So for every 4 shares that we acquired, we provided 1 new shares. So 60,000 divided by 4 multiplied by 1, that means 15,000 shares. 15,000 shares we provided of our own. Now these are 15,000 shares, but what is the valuation of these shares? Quickly, if we can go down and again refer to note number 1, examiner says Panama company has recorded its investment in Trilby company at the amount of cash consideration. Oh wow. So basically Panama company has already recorded this investment at the amount of cash consideration, but has made no entries for shares consideration. And even we can, cross-check this information. It says that we have recorded cash consideration, but nothing has been recorded for shares consideration. If we go above and see in the individual SOFP of Panama company, there it is written investment in Trilby company with a value of 200. So only the cash consideration has been recognized. No accounting entries have been made for shares consideration. That means we need to do that. All right. Examiner says at the acquisition date, the market value of Panama company's shares was $10 and the market value of Trilby company's shares was 5.9. Now we have been provided share price of both parties, parent company and subsidiary both. And I certainly think that you guys know why 2 share prices are relevant to us. I think parent company share price is relevant for us because we need to value the shares consideration. I mean, we have given our own 15,000 shares now. So we need to value our own shares at our own price. But why is this Trilby company's share price given? I mean, you might have guessed it already. This would have been given to you so that you can calculate fair value of NCI at acquisition if it's required. So, yeah. So let us go and calculate the value of shares consideration here. We had given 15,000 shares and these were with a value of $10. So the whole valuation of shares consideration come up to be of 15,000. Now, whenever we go and calculate goodwill, both this cash consideration and shares consideration amounts would be relevant for us. This is total consideration of 350,000. But guys, you need to remember this. Examiner said that we have not recorded this shares consideration in our books. So we need to do it. And what would be the accounting entry for this? It would be investment in subsidiary company debit with a value of 150,000. And what is going to be credited? I mean, we provided equity to the other party. We issued equity to the other party. So the accounting entry should be share capital credit and share premium credit. Share capital is always recorded with par value. So we issued 15,000 shares. Par value was 1. So 15,000 is the share capital. And whatever remains goes into the share premium. We need to recognize this accounting entry within our books. And when I say we need to recognize this accounting entry within our books, that means that we need to update this value of investment. And also update our share capital, which is provided as follows. Share capital and share premium. We need to update this. Make sense? So another 15,000 would be added to share capital, another 135,000 would be added to share premium. Investment value would add up, will additionally, sum up 150,000. Having said that, I would also like to highlight one more fact. You guys know now already that our investment and the other party's equity is knocked off during consolidation process. It is an intra-group balance. It needs to be eliminated. So I've just knocked it off. Remember, although we need to update something here, but still it will be knocked off. Only the share capital and share premium of parent company needs to be updated for the purpose of consolidation. All right. Moving on. Let's move on to note number 2. No. I always suggest to students, whenever you are in an examination question, do not skip the financial information, though. Do not skip the financial statements extract. Always go through the financial statements extract whenever they are provided. Always go through them in advance. It will allow you to have better understanding of the notes available. All right. So here it's written, you have been provided 2 statement of financial position of the individual companies, Panama company and Trilby company. First of all, you have been given property, plant and equipment of both entities, 480,000 for Panama company, 457,000 for Trilby company. When we consolidate, we will consolidate these two as if we own everything. So we will consolidate everything. Then we have been provided with some investment property, and this investment property of 144,000 only belongs to Panama company. Yeah, remember that. Then there is no investment, it had already been knocked off. Moving on to current assets. Current assets, we have inventory, receivables, cash, we have total assets. Then in equity, we have share capital and share premium, but still that needs to be updated while we consolidate. Then we have been provided retained earnings, closing retained earnings of 518,000 and 371,000. These are closing balance sheet date retained earnings. While doing consolidation, you guys should remember that we are, for subsidiary company in particular, we are not only interested in the balance sheet date retained earning as such. At the same time, we also need the pre-acquisition retained earning so that we can appropriately calculate goodwill and also work out the post-acquisition reserves. Remember? So do not get satisfied from this information as yet, because we would need to work out, we would need to seek in this question some pre-acquisition retained earnings as well. Yeah. Then there are some non-current liabilities and current liabilities provided. Well and good. Let's move on. Then there is note number 2. In note number 2, we had already done note number 1, by the way. Note number 2 says Panama has elected to measure the non-controlling interest in Trilby company as a proportion of net assets. Oh, wow. It says NCI is to be determined not based on share value. Till now, we thought that NCI would be calculated based on share price. Yeah, as if everything, as if it was always happened in other questions. Yeah, but not in this question. Examiner says the company has opted a strategy to calculate NCI as a proportion of net assets. That means this market value is of no use for us. No use for us. We need to calculate NCI as a proportion of net assets. One more point that comes to my mind. We are calculating NCI as a proportion of net assets, and we know how to do that. We'll do that in a bit. But when you determine NCI as a proportion of net assets, in particular, I'm talking about goodwill, methodologically, it will be known as full goodwill method because you are determining NCI value. But technically speaking, you guys already know this. Whenever you calculate NCI as a proportion of net assets, since NCI is just a proportion of net assets, it gets cancelled off during the calculation of goodwill, and only parent company's goodwill remains. So methodologically, it would seem as a full goodwill method. You can call it full goodwill method, but the answer that comes to you only represents parent company's goodwill. Remember that fact. Okay, let's move on. Note number 3. At 1st March X7, again examiner is talking about the acquisition date. As 1st March X7, Trilby Company's property had a fair value of $36,000 in excess of its carrying amount. In excess of its carrying amount. So what is this? So basically, you are at the acquisition date, Trilby Company's property has had an upward fair value adjustment. So I can write down maybe working number 2 here. If the above one was working number 1, I can write down upward fair value adjustment of property. Yeah. So you had a property for which there is an upward fair value adjustment of 36,000. What should be the accounting entry? Property should be debited by 36,000. What is going to be credited? Credit is going to be under goodwill. Remember, whatever happens on the acquisition date always affects your pre-acquisition net assets and therefore the goodwill. I just made up an accounting entry for you guys to better understand. But are you required to make an accounting entry in your examination? The answer is no. You're not required to do that. But still, I've just made it so that you get better understanding. All right. Now your examiner says that the property has a remaining useful life of 20 years. The property has a remaining useful life of 20 years. This means you need to calculate excess depreciation here. Obviously, you have upward fair valued your assets in consolidated books. And due to this upward fair valuation, some extra depreciation would arise. And therefore, we need to calculate excess depreciation. Yeah. How do you calculate that? 36,000 is the upward fair value adjustment. Life examiner said is 20 years. You make a division and you have it 1800 per annum. Now remember guys, the post-acquisition period, after the acquisition, the post-acquisition period is just 4 months. So we just need excess depreciation of 4 months and nothing else. So multiplied by 4 and divided by 12. This is the exact depreciation that you would need. And since this would be recognized against S company's books, therefore it would be charged to both CR and NCI. Remember that. All right. Let's move on. Working number 4. Examiner says in the year ended 30th June X7. Now, when your examiner says in the year ended 30th June X7, your examiner is talking about the whole year, 12 months. So in the year ended 30th June X7, Trilby Company made a profit of 33,000, which accrued evenly across the year. So in the 12 months to 30th June X7, Trilby Company had made a profit of 33,000 for the whole year. For the whole year, 12 months profit, 33,000. Believe you me, this information is very relevant for you guys. You know why? Because, this information would allow me to calculate pre-acquisition retained earnings. Yes, definitely it would allow me to calculate this. How? You see, you had been already provided with closing balance sheet date retained earnings of 371,000. So I can write, closing retained earnings as per balance sheet, which is 371,000. And your examiner just said that, this 371,000 includes the whole year's profit of 33,000, includes the whole year profit of 33,000, whole year profit. So if the whole year's profit is 33,000, then what would have been the post-acquisition profit? Post-acquisition profit, just 4 months. It said, examiner told you that it accrued evenly throughout the year. So 33,000 multiplied by 4 divided by 12 is 11,000. So if you need to work back and calculate pre-acquisition or acquisition date retained earning, how would you do that? You see, 371,000 also includes 4 months of this year's profit. And if I were to ask you what would have been your retained earning 4 months back, you would just exclude this 4 months profit, which had accrued evenly across the year. You would have had a pre-acquisition retained earning of 360,000. And believe you me, this information is very important for you. Why? Because we need pre-acquisition retained earning for the purpose of goodwill calculation, for the purpose of CR. We need this information. And by reading these two lines, we have just determined pre-acquisition retained earning in this question, which would be very helpful for us, right? So now moving on. It additionally says, note number 4, this was considerably lower than previous years. Panama companies directors were aware that Trilby companies was struggling to control cost. So examiner has just pointed out something in front of you. Examiner told you that Trilby company earned a $33,000 profit this year. But at the same time, your examiner is saying this was not enough. As compared to previous years, as compared to previous performances, 33,000 was a very diluted number. And the examiner is saying that Panama companies directors are aware of the fact that Trilby company is not managing their performance very well. They are not, able to manage their costs. So something is wrong. And what happens when something is wrong? What happens? What do you do when something is wrong? For example, what do you do when you know that there is something wrong with your study strategy? What do? You make sure to rectify your mistakes. You remove your shortcomings. You redefine yourself, make a new strategy, and then move on. That is what you would do if you were preparing for your examinations. Likewise for a company. If Trilby company is not able or is struggling to control their cost, they need to rectify their mistakes. They need to reorganize themselves in order to improve. And that is what they should have done. So examiner is basically saying Panama company's directors were aware that Trilby company was struggling to control cost, and prior to the acquisition date, they had already decided to restructure Trilby company's business to eliminate a layer of management. Your examiner is making up a point. Your examiner is saying that Panama company, the parent company, already knew that Trilby company was not performing well. And so even before the acquisition, they had already decided that they would restructure Trilby company. They would just lay off a certain layer of management. They would restructure the organization so to control the cost. What comes into your mind when you hear this word restructuring? I'm very sure restructuring provision under IAS 37 comes into your mind. And IAS 37 said that a restructuring provision should be recognized whenever there is the case, but subject to meeting two conditions. And the first condition was there must be a detailed formal approved plan. I certainly think that there was a detailed formal approved plan available even before the acquisition date. How do I say so? Because they have come to the conclusion that in order to control costs, they need to restructure the organization. Now that wouldn't have happened, that wouldn't have happened if there was no detailed plan. There must have been a detailed plan which had been approved by directors, and thereon they had decided according to that plan that they will be eliminating an entire layer of Trilby company after acquisition. Yeah. So there is certainly a detailed formal plan available prior to the acquisition. But there was another condition of IAS 37, which was the plan should have been communicated to the relevant stakeholders, that is, those who are to be affected by that plan. Now, it's very important for us to determine when this restructuring plan is communicated to those who are to be affected by that plan. Because if about the restructuring plan, the announcement is made before the year end or at the date of acquisition, then it becomes a pre-acquisition scenario. You would be recognizing a restructuring provision at the acquisition date. However, if such an announcement is made, that is, the conditions under IAS 37 is met after the date of acquisition, then it will be a post-acquisition transaction. So you need to figure out when this announcement is made, or even if it's made or not. Examiner says this would incur expected redundancy cost of 60,000. Okay, thank you for telling us that. Examiner says the restructuring plans were announced to Trilby company staff. So it has been announced immediately after the acquisition. Oh. This means the criteria under IAS 37 was met after acquisition and not on the acquisition date. The restructuring plan was announced to Trilby company staff immediately after the acquisition. So this is a post-acquisition transaction, and therefore a restructuring provision should be recognized by Trilby company. I mean, obviously Trilby company is going to lay off their employees. Therefore, a restructuring provision should be recognized by Trilby company, not the parent company. It should be recognized after the acquisition. It will be recognized post-acquisition. And even your examiner says, and will commence in July X7. July X7 means beyond the year end and completed by December X7. The intended restructuring costs are not reflected in either company's financial statements. Basically, you need to recognize a restructuring provision. I can make an accounting entry for this as well. Working number 4, restructuring provision. A restructuring provision should be recognized and it should be held till the year end as well, because the acquisition will continue even after the year end. Remember this. What should be the accounting entry for this? I mean, definitely provision would be credited by 60,000. That's for sure. What would be debited? CR and CI by their respective portions. I mean, both type of equity holders are responsible for S company. So whatever happens in S company, they are going to bear the brunt of it. Yeah. So CR and NCI. CR means consolidated retained earnings. Yeah. Debit and NCI debit. All right. So remember this. We are going to knock this off while we are preparing consolidated retained earnings. It's important for us. And a liability should also be recognized in our SOFP. All right. Remember this. Moving on. Note number 5. Throughout the year ended 30th June X7, Panama company has bought 8,000 goods from Trilby company per month. So your examiner is saying, you see, Panama company used to buy goods from Trilby company. Trilby was their supplier. Even now, it's the supplier of Panama company individually. So what they are saying is that there had been a transaction value of $8,000 worth of goods each month for the entire year. But remember, we are not concerned with the entire year. For the purpose of consolidation, we are only concerned with the post-acquisition transactions, not the entire 12 months. Because the post-acquisition transactions are intra-group transactions and those need to be taken care of very carefully, right? 4 months. Examiner says Trilby makes a markup of 25% on these sales. Okay. At 30th June X7, Panama company still held all of the goods bought in May and June X7. So basically, remember URP. You know what we are coming towards? We are coming towards working number 5. And this is going to be related to URP S2P transaction. S2P transaction. And you remember now, unrealized profit is only up to the extent of closing inventory. And your examiner just told you that Panama is carrying 2 months worth of goods in its inventory for May and June. So inventory would have been 8,000 multiplied by 2, 16,000. URP would have been, 16,000 divided by 125 multiplied by 25. So URP would have been of 3,200. And this we need to take into account while we are preparing our CR as well. Remember this. Additionally, examiner also says that it's still owed, Panama still owed Trilby company for all the goods bought in June. Still owed. So basically, Panama still owes 1 month purchases value to be paid to Trilby company. So there is an intra-group receivable and payable. I can write down an instruction for you. Intra-group receivables, payables of $8,000 exist should be knocked off during consolidation. Yeah. So this should be done. Remember this. Do not forget this. Okay. Last but not the least, last accounting entry. It says that Panama company acquired its investment property on 1st January X7. So just 6 months before the year end, Panama company, which is the parent company, bought some investment property. The property cost $144,000. And I remember this $144,000 was written in the Panama's company's SOFP. So the original acquisition value is still reported in Panama's company's books. Examiner says the property cost $144,000 and had a useful life of 50 years when it was acquired. Okay, understood. I'll just highlight this fact. Examiner says Panama company's directors have decided to adopt the fair value model for investment in property. Oh, Panama company has adopted fair value model of investment property. And in under fair value model, you only mark to market to recognize any fair value gain or loss. Remember, no depreciation is recognized, and therefore the useful life information provided to you is irrelevant. If some student also recognized depreciation because life was given and also did mark to market at the reporting date, then it would not be the true reflection of IAS 40. Examiner says Panama company's directors have decided to adopt the fair value model for investment property and have been advised that the fair value of this property is $170,000 at 30th June X8. So what you need to do, working number 6, I can write investment property here. So the carrying value of this investment property was $144,000. Whereas the fair value at reporting date is $170,000. And your examiner also says that other than recognizing the property, no accounting entries have been made. So basically, there is a fair value gain of $26,000, and this will only be recognized by parent company. You can make accounting entries if you like, if you remember that way. But otherwise, just writing for the sake of your memory that 26,000 will be recorded by parent company. This is more than enough. All right. So now, guys, we are done with all the notes. And now we can move forward. Yeah. Can we move forward and prepare consolidated SOFP as yet? At least 3 numbers you need for every consolidated SOFP. For every consolidated SOFP, there are 3 numbers that you always need. What? Number 1, it is goodwill, then CR and NCI. These are the 3 minimum things that you always need for consolidated SOFP. So I would prepare here working number 7, and this will be for goodwill. So how do you calculate goodwill? First of all, I would need P companies consideration. The P companies consideration would comprise of both cash consideration and shares consideration, and we can link that. I would just move my arrow key, move towards cash consideration plus shares consideration. It would give me a total of 350,000. Yeah. Then I would take fair value of NCI at acquisition. I remember that fair value of NCI at acquisition had to be calculated using a proportion of net assets. So I need net assets here. I would write fair value of net assets of S company at acquisition. Yeah, I need this information. So I need net assets. Net asset means assets minus liability, which is equivalent to equity. And when we talk about equity, equity means share capital plus all reserves. So I need share capital of S company at the acquisition date, and also its reserves. Reserves means for us, the reserves were retained earnings. And all of this information needs to be related to acquisition date. Now we know that share capital does not change even after acquisition. So if balance sheet of Trilby company shows 80,000 of share capital, it would have been the same at the acquisition date as well. So share capital 80,000 here, retain earnings at the acquisition date. Do you remember we calculated this in advance? We had done a working for pre-acquisition retained earnings. Here we have it 360,000. We will bring it here. Done. Anything else to be done? Yes. There was an upward fair value adjustment of property. I remember it was the value of 36,000. I'm just going to link this so that examiner can trace back to my workings where I have, taken this information from. This is a good strategy for your examiner. Make the life of your examiner easy so that examiner rewards you mark very easily. Yeah. So the total net assets that we have are 476,000. NCI can be calculated as a proportion of them. So 476,000 multiplied by 25%, the NCI is holding. And now if we calculate goodwill, this would be summing it all, netting it all, would be 7,000 minus. So should we write negative goodwill? Guys, there is no such things as negative goodwill. This is basically gain on bargain purchase. And this will be recognized by parent company. All right. So we are done with gain on bargain purchase as well. Let's do working number 8. And this will be for consolidated retained earnings. Now, how to prepare for consolidated retained earnings? The easiest method is that you first find out how many companies you need to consolidate. There are 2 companies in our question, Panama and Trilby. Make a column for them. Panama company, Trilby company, right? These are the 2 columns that we need. Then you start this working with retained earnings as per balance sheet date. Whatever is provided in the question already. So you have been provided retained earnings with a value of 518,000 and 371,000 for Trilby company, already provided to you. Now what do? You would subtract less pre-acquisition retained earnings from Trilby company. Remember, there is no pre-acquisition for Panama. It's our parent company. It had been our company since the beginning. For Trilby, we need to get the pre-acquisition retained earnings from here, and here we have it. I'm sorry for these movements. Post-acquisition retained earnings as follows. I mean, this is the easiest method that you can work out. Post-acquisition retained earnings, 518 and 11,000. Yep. Now we need to perform some adjustments. What were the adjustments that were to be made to retained earnings of either companies? I remember there was some excess depreciation on property, and then there was some URP on an S2P sale. Remember, S company had kept the profit. In an S2P transaction, S company or subsidiary company is the selling party. So any unrealized profit charged is charged by the selling party or the subsidiary company. We would be eliminating the unrealized profit from their financial statements. Okay. And then there was some gain on bargain purchase. This will be for, parent company. And then there was also a restructuring provision. I remember restructuring provision. This will be recognized by S company, the Trilby company. Now let me get these numbers. Excess depreciation, 600. Yep. Linking up the workings. URP was 3,200. Very good. Then there is gain on bargain purchase. This will be a positive, guys. 7,000 positive. It's a gain. Restructuring provision, 60,000. Yeah. The principal rule is whatever transactions relate to whatever company, you write the relevant transaction with full values and that company's column. No proportioning till yet. Once you are done with all the adjustments, you calculate adjusted post retained earnings. Here you have it. The sum is 525,000 and 52,800. Now, S company has an adjusted retained earning or a retained loss rather of 52,800, but we are not entirely responsible for it. We are only responsible for 75% of it. Yeah. So I would write here share of S company, which is 52,800 into 75%. Our consolidated retained earnings in this case would be 52,500 netting offer from 39,600 consolidated retained earnings. All done? Good. 75% we had. Where does the other 25% go? We will do another working number 9, and this will be for non-controlling interest. Yeah, working number 9. We will start with fair value of NCI at the date of acquisition. Okay. Now, fair value of NCI at the date of acquisition, we had already calculated this as a proportion of net assets. I remember this was calculated under goodwill. So yeah, 119,000 is the value. Then we would be giving them share of post retained earning 25%. So this would be 52,800 loss into 25%. Our NCI closing would be this number, 105,800. Now we have done it all. We have done it all. And without any further ado, I would move on and start preparing a consolidated SOFP as at 30th June 20x7. We'll start with non-current assets. It's very easy, guys. It's very easy. Just follow the format which already has been provided to you. We'll start with non-current assets. In non-current assets, first of all, we have property, plant and equipment as per IAS 16. We consolidate as if we own everything. So 480,000 plus 457,000. But yes, there was a fair value adjustment above of 36,000, and I'm subtracting excess depreciation from here as well, so that the net value comes up to be 972,400. Yep. Then the next area is investment property. I remember we had already calculated investment properties closing value. I can link this for my examiner so that he feels very much confident of my work. 170,000. Then, there is no investment, it's knocked off. Against this investment, there is goodwill. But again, should we be writing goodwill here? In this case, there was negative goodwill, and negative goodwill is not your asset. Common sense, asset is either 0 or a positive number. An asset can never be a negative number. So there is no negative goodwill. There is no such things as negative goodwill. We can move on to current assets. Current assets. So in current assets, we have inventory, receivables and cash. Inventory. We have been given inventory balance of 63,000 plus 42,000. But remember, we had to eliminate our URP as well from group inventory. So URP, guys, it was 3,200, eliminating that as well. Then we are given receivables. Receivables are 41,000 plus 24,000. But yes, there was an intra-group receivable. Remember, 1 month's transaction value was still pending between the parties. So 8,000 would be subtracted as an intra-group receivable payable. Yeah. Then there is cash. I guess cash is only with Panama company. So 10,000. Here we have our total assets. And guys, these will equate to 1,311,200. Okay. Then we have equity and liabilities. Yep. First of all, we'll talk about equity. Equity, we have share capital. We have share premium. Remember, share capital and share premium of S company was already knocked off. And share capital of S company needs to be updated. So 100,000 is already provided plus the consideration value, 15,000. And then we will have share premium of 35,000 ready-made. It's given here. And we will add up share premium of 135,000. All right. Then we have retained earnings, or rather I should write consolidated retained earnings and NCI 2. Consolidated retained earnings we prepared. They were with a value of 485,400. NCI was with a value of 105,800. And then we can move on to non-current liabilities and current liabilities. Non-current liabilities should come as it is. 180,000 plus 40,000. Then we have current liabilities. Current liabilities are already 105,000 plus 32,000. Yes, there was an intra-group payable of 8,000 knocked off. Plus, I would be increasing this current liability from restructuring provision as well. I'll be adding 60,000 here as well. So 60,000 here. Yeah. So total equity and liabilities would be it does not balance. What am I remaining? Okay, so the difference here is 26,000. What was the 26,000 I'm missing? Am I missing something? 26,000 seems as a familiar number. I remember there was something 20. Oh, fair value. Didn't I recall? Oh, no. See, I missed this out. There was a fair value gain for parent company on investment property of 26,000. I need to incorporate this as well. And this will only be for parent company, since investment property was only available to parent company. You see, since I had already linked all my workings, I hope my balance sheet, is balanced altogether. This is the benefit of linking your whole spreadsheet. One mistake, you go and find that out, correct that there, and your balance sheet will balance automatically. Yeah. So guys, we have done this. If you watch this video and you like it, just reach out to me so that I know that you like it. It would really encourage me. Your success is my success. So if you feel good about it, if you understand about it, just let me know about it. All right. Take care. Allah Hafiz.